Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to walk you through a potential trade setup based on a post-earnings trend trade, and it's based on statistics of Google. So, trading is all about business of probability. So, when we have an earnings trade set up, there are a couple different ways you can trade into an earnings. You can trade a pre-earnings trend trade into earnings, a non-directional that would, be a trade that you would do for an earnings release, or a post-earnings trend trade. So, this is an idea for a post-earnings trend trade on Google. So you can see Google here had its earnings release today. It was trading about $11.36 on the close. The expected move was about $47 up or down. So that's about a little over 4% move up or down is what the market was expecting Google to do tomorrow, one day after the close, okay, based on its earnings release. So you can see the implied volatility for Google's normally about 23% or so, and here it's 76.57%. So really big spike on implied volatility. So let's take a look. I'll show you one potential kind of post-earnings trend trade, and this would be using a bull put credit spread. Now, when we study the Google's going into its close on an earnings release date, the implied expected move is about 4.5–5%. You can see here's past all the past history of the seasonality cycle. So here last cycle was 3.77. So call it 4%, a little over 4%, and that's where the expected move was for this cycle. Now let's take a look and see what Google does after an earnings release when it has a move after the close the next day of around the expected move or greater. So when we look at Google, the earnings were just released and it came out much greater than the expected move. It came out, and now it's post earnings after the release. In the post market aftermarket, it's up about 9%, so 2x the normal about 4% expected move. So that's potential for a big kind of fall through to keep Google stable to the upside, and one way to play that would be a bull put credit spread. So let's walk through this again. So Google here today closed before the earnings were released. Earnings are today after the close. It closed at 1135.94, and based on the expected move, the market was forecasting 4% up or down. The upside expected move range would be 1183. And let's take a look now post earnings. What we really want to see is what this does tomorrow on the open, but if you were to base this on what it's doing tonight, we'll put this to a 1 hour time frame and show after hour trading, and you can see that the Google's after hours trading up here to about 1238, 1240, and that's better than, that's a 2 standard deviation move here. So here's 4% up, here's about 8% up, and it's trading about 9% up. So statistically, when that happens, if we come in tomorrow and the cash market opens up 2% or 2x standard deviations up, probability is that Google will stay to the upside for the next 7 days to a week. So let's take a look at those statistics. And then based on that, you could sell a bull put credit spread out of the money. You wait for 30–40 minutes to an hour, and then you sell like a 20 delta bull put credit spread. That's your short strike on the put, and then it's a put credit spread. Gives you a high probability trade setup going in, and you do that for the next week out. So let's take a look at the statistics post earnings for Google and see how this potentially aligns. So let's take a look. So these are post earnings statistics for Google for all of its earnings cycles going back back to 2013. So here's the move, the opening of the next day. So this was a down move, but let's take a look at an expected move and see what happens. Here is comes in at about the expected move here. This was the 2018 July series. So opened up at 4.95% up, and then 5 days later it was still up, but that's not even 2 standard deviations. That's about a normal expected move. So when we come down and we look at something bigger, so here's one for 10%, then you can see 5 days later it was still up. It was up 7.58%. All right, so when you look at a move greater than the expected move, and this is not even 2 standard deviation, that's about 2. It's 4 and 8%, 10%. So this was about 2%. So you can see 5 days later, the next week, this would be the next Friday's expiration, it was up almost 8%. This one 12%, still up 5 days later, up over 15%. So these big moves, here's another one, 9.87, it was up 13.29. So what this tells you is that the potential, the probability is for Google to stay steady to the upside. It doesn't mean that it could really blast and go much higher, but what it does tell you is stay steady. So one way to trade that is to sell a credit spread that takes advantage of time decay, and you sell it out of the money, so you give yourself a little room in case case it pulls back. So based on these statistics, one trade possibility or setup that you could look at would be tomorrow, let Google open up, give it about an hour to see where it stabilizes, and then if it's up that 2 standard deviations, then you sell a bull put credit spread based on the short strike of the put spread for next week's expiration at about a 20 delta or 25 delta on the short strike. So I'll show you kind of what that would look like. So if we're looking at next week's option chain here, so the 2 August would be the series you'd look at, and you see the expected move for next week is $55 up or down. So if Google, when it comes in tomorrow, if it's up here at that kind of 1200 level or that 9% up, hold on, let me show you. So tomorrow Friday, if it opens up and it's trading around 1230 in this range, 2 standard deviations up on the open, you wait about 30-40 minutes, let it stabilize, see where it is, and if it's still trading around 1230, then you'd sell the expected move, which is about $55 down, would be about a 20 delta short strike on a bull put credit spread. So that'd be about 1175. So you'd be selling the 1175 bull put credit spread, and then below the 1175 you buy the 1170. So actually do this as a $2.50 wide spread, so you buy the 272.5 spread. So $2.50 wide spread, try to get $50 credit or greater. That'd be a 25% return on a high probability trade. So this would be like a 20 delta. So that's also telling you that there's an 80% probability that price should close above 1175. Okay, so that's just a trade idea and a way to look at Google post earnings based on statistics and using a credit spread or selling premium. Hope this helps. Talk to you on my next video update.